Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, the 22nd of August 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Currency Analyst from London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Abdul-Ahad.
So Fed Chair Powell has just delivered his keynote speech at Jackson Hole. What were your initial takeaways?
Yeah, certainly it has had a big negative impact on the dollar. Initially, we've seen the dollar fall by over 0.5% against most major currencies in the initial aftermath of that speech. And to us, that kind of sends a kind of clear signal that the Fed is kind of moving closer to resuming rate cuts. Fed Chair Powell did state quite clearly that they are willing to adjust policy in response to the rising downside risks to the US labor market. He obviously had to acknowledge that the recent employment report was much weaker than the Fed had been anticipating, and with employment growth averaging just around 35,000 per month over the last 3 months, that's really kind of getting to the point where the Fed is obviously going to become increasingly concerned about whether the labor market weakens further from here. They feel that they would have to take more prompt action to loosen monetary policy. So to us, it does send a very clear signal to the market that if we get another similarly weak employment report at the start of September, then the Fed will be cutting rates by 25 basis points in September. So for the dollar, that to us is certainly a negative development in the near term and could lead to some further dollar weakness in the week ahead. And Abdul-Ahad, I know you've been looking into past price action around Jackson Holes. What were your kind of takeaways?
Yeah, thanks, Lee. So this week we assessed whether pre-event volatility conditions measured by 1 month at the money implied volatility percentiles can help predict post-event FX price behavior for dollar yen and euro dollar. And the focus was on five-day cumulative returns following Jackson Hole, approximately a 1 week horizon. So when looking at dollar yen, when pre-event implied volatility was elevated, dollar yen experienced a larger absolute move in the price in the 5 days after Jackson Hole. And when we looked at euro dollar, there wasn't really a consistent relationship between pre-event implied volatility and post-event moves. We also took a look at the DXY reversal dynamics, where we concluded that using the event day close as reference point, initial Jackson Hole impulses typically fully reverse within 10 trading days an average, or median 8 days. So this pattern is symmetric. Both dollar rallies and sell-offs tend to fade over a 2 week horizon, reinforcing a fade the event day close bias. So given the current market context, our expectation of dollar yen having a muted reaction was proved wrong. Dollar yen is currently surging around 91 pips on the day, indicating a sharp repricing. What's the implication for that? So the normalization process may take a little bit longer as markets recalibrate to new policy signals, challenging assumptions based on pre-event volatility compression. So outside of the US, what are your expectations for the major central banks and potential impact on FX market performance?
Yeah, I think certainly we think going forward, we do see some potential for divergence to open up between the Fed and other major central banks. With the Fed looking more likely to resume rate cuts in September and likely cutting rates at least 2 times by the end of this year. That could create more of a divergence there with other major central banks outside of the US. Certainly, we're becoming less confident in our view that European central banks like the Bank of England and ECB will cut rates further this year. The data flow from Europe has been more positive than we had anticipated. growth holding up better than we had initially anticipated. As we saw this week as well, the latest kind of business confidence surveys have shown certainly a stronger improvement in business confidence in August, which is obviously an encouraging development. It does indicate at the very least that the downside risks to growth in Europe have diminished in response to the recent trade deals that we saw signed between the US and the EU, and the US and the UK. So with those downside risks diminished to the growth outlook, there's less pressure on European central banks like the Bank of England and ECB to cut rates further this year. And we're starting to see that being reflected more in the communication from those central banks. The Bank of England, obviously, at their last policy meeting, indicated that there was now a higher hurdle for them to continue cutting rates every quarter, which has made it less likely that they'll cut rates again as soon as the November meeting. And similarly, the ECB, we do expect them to start to indicate more strongly to the market that they're likely to keep rates on hold in September and potentially through the rest of this year. So with those major European central banks keeping rates on hold and the Fed cutting rates, that yield differential story could trigger another leg lower for the dollar. And obviously the dollar sell-off would be reinforced further if we did see the market becoming more concerned about President Trump's interference in Fed policy setting going forward. This week we have seen fresh calls from President Trump to fire Fed officials. Previously, he has called repeatedly on Fed Chair Powell to step down and even threatened potentially to sack him. Obviously, we don't think he'll follow through on that threat. But the new kind of threat, which we're watching more closely, is his threat to fire Fed Governor Lisa Cook. On that side of things, there is obviously a higher risk that he could follow through with that threat. And if she was to step down early from her term, was replaced by someone President Trump would pick as the next Fed governor, that would only really strengthen his influence on Fed policy setting going forward. And that's something we already expect to happen anyway when Fed Chair Powell is replaced next year. But certainly the risk there that another Fed governor could be replaced would certainly heighten downside risks for the dollar going forward. Thanks everyone for listening.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe to our podcast. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.